Kevin Warsh is going through confirmation hearings today to become the next chair of the Federal Reserve. And if you think that sounds like boring Washington stuff, hang on, hold on, stick with me, because this could affect everything from interest rates, small business loans, and the cost of borrowing across the economy, which also includes mortgage rates. So you might be asking, who is Kevin Warsh? Why is he suddenly everywhere? And what could he actually do if he takes over the Fed? Let's break it down. Kevin Warsh is not some unknown policy guy who appeared out of nowhere. He's former Federal Reserve governor, a former Morgan Stanley banker, and a former White House economic advisor under President George W. Bush. He also served on the Fed during the 2008 financial crisis, which means he was in the room during the biggest financial meltdowns in modern history. So when Warsh talks about markets, banking, or economic stress, he's not speaking in theory. He's been inside the machine when it's happened. That said, he's also not your typical academic central banker. He comes from the world of finance, markets, government, and deal making than from the professor side of economics. And that matters because it helps explain how he sees the Fed. At today's hearing, Warsh is expected to tell lawmakers that Fed independence is essential. That is important because the Federal Reserve is supposed to make decisions about rates and inflation based on the economy, not based on who is yelling the loudest in politics. But here's the twist. Warsh also argues that the Fed has drifted too far from its core mission. He has criticized what many call mission creep, meaning that the idea that the Federal Reserve has expanded into too many areas instead of staying tightly focused on inflation, monetary policy, and financial stability. In plain English, Warsh's message is basically this. The Fed should stop trying to be everything to everyone and get back to its main job. And for him, that main job starts with inflation. He has made clear that inflation control is central, and in his prepared remarks, he has said that the Fed has to take responsibility for it. And when we talk about taking responsibility for it, what Warsh really means, as he has described himself, is that he is wanting a more reform-oriented Federal Reserve. That phrase sounds dry, I get it, but it's actually a big signal. It means he's not walking in saying everything's fine, let's keep this train moving. He's walking in saying this situation needs changes. And one of the biggest areas where he may want to change is the Federal Reserve's massive balance sheet. If you hear balance sheet and your brain immediately tries to leave your body, stay with me because this part really matters. The Fed's balance sheet is basically the giant pile of assets, mostly treasury bonds and mortgage-backed securities that the Federal Reserve bought over the years, especially during and after crises. Those purchases were meant to support markets and push borrowing costs lower. Warsh has criticized the giant balance sheet and argued that it's become too large and too distortionary. And that brings us to the question small business owners should care about most. What happens if the Federal Reserve starts shrinking it more aggressively? Economists generally say that if the Fed shrinks its huge balance sheet faster or actively sells more of those bonds into the market, the most likely result is higher long-term bond yields. You might be asking why. Well, because if the Fed is holding fewer bonds, private investors have to hold more of them. And when more bonds hit the market, prices usually fall and yields usually rise. Supply and demand. That may sound abstract, but it has real world consequences. You might be asking, well, what are those? Higher long-term bond yields can feed into things like small business loans, equipment financing, commercial real estate borrowing, mortgage rates, and broader business credit conditions. So if Warsh pushes for a smaller Fed balance sheet, that could mean borrowing stays tighter and more expensive, especially for smaller firms that rely on bank lending or credit to grow. In other words, if you run a small business and we're hoping for easier, cheaper access to capital, an aggressive balance sheet reduction by the Fed could move in the opposite direction. There's also another layer here. Warsh is being pitched by supporters as someone who can restore discipline at the Fed. However, critics are raising questions about his financial holdings and whether he would really remain independent in a politically charged environment, especially with President Trump. So this isn't just a resume hearing, it's also a test of what kind of Fed he would run. So here's the bottom line. Kevin Warsh is a former Fed governor, Wall Street banker, and White House advisor who says he wants a more disciplined Federal Reserve with a tighter focus on inflation and less mission creep. He's also skeptical of the Fed's giant balance sheet, and economists say shrinking that balance sheet more aggressively would most likely push long-term rates higher, which could keep pressure on small business loans and borrowing costs. So yes, the confirmation hearing is political theater. They almost always are. But it's also something much more practical. It may be a preview of what borrowing money could look like in America over the next several years. If you like this content, please make sure to subscribe, hit like. If you got any questions, any thoughts, any comments, put them below. We always try to respond to every single comment as they come in. As always, please subscribe. Thanks for watching.